And for more on that, now I'm joined by Nariman Behravich, the Chief Economist at IHS. Thanks very much, Nariman, for joining us here on CNBC TV 18's Big Picture. Let me first ask you, clearly everybody is now expecting a rate hike tomorrow, and many are saying if she doesn't, then it would just be sort of an anticlimax. How do you weigh in on this? Is it a given?
Well, we definitely think they're going to raise rates. If they don't, I think they're going to have a huge credibility problem because they've talked about this for so long, and everybody's talked about it for so long. So to me, it's a foregone conclusion they're going to raise interest rates. As you were speaking earlier, the next big question is, where do they go from here? How many more rate hikes, say, in 2016? We're saying 4, but it's very important to put this in context because even at the end of 2016 and even into 2017, interest rates are going to be well below where they were, let's say, in 2006. So even these kinds of modest rate hikes don't really create a big challenge for the U.S. economy.
Right. Fair enough. I mean, but the big question many, in India and many of the emerging markets are wondering is the sort of, turbulence that could follow owing to the a possible Fed rate hike and its impact on emerging markets. Do you think that turbulence is only natural and with time, of course, things will stabilize?
There's no question that turbulence is part of the picture here. Unfortunately or fortunately, we're looking at the Fed essentially having huge influences globally. We know from past episodes of Fed tightening that there's sort of a flight to quality or flight to safety, if you want to say it that way. And so investors tend to come back into the U.S. From emerging markets. And so this has already happened to some extent. The markets have anticipated this increase. As I said earlier, we've talked about it so much that to some extent markets have already factored it in. But as the Fed continues to hike, my guess is every time it hikes one more notch, then we will see some turbulence, especially in the emerging markets. So unfortunately, again, this is sort of part of the global landscape we're facing right now.
Right, but you're saying that largely most emerging markets may have already priced it in, considering the fact that the talks of tapering and moving to sort of increasing interest rates has been going on for quite some time now.
That's correct. I mean, I think if the Fed's rate hikes are going to be gradual, which we think they are, my guess is that the damage to emerging markets will be limited. I'm not saying non-existent, but limited. Because these are small changes that we're talking about. I know it's the first time in nearly 10 years the Fed's going to hike rates. I understand that. But everybody's talking about fairly modest increases in U.S. interest rates.
Right. When you talk about, the impact on emerging markets, primarily 3 things come out. One is the impact on the domestic country's currency. 2 is the impact on their own interest rates owing to a possible Fed rate hike. And the third would be in terms of capital outflows. If I could just take one at a time, Nariman, because we've seen as far as the impact on currency is concerned, in the last 6 to 7 weeks, the renminbi has sort of weakened by about 1.8%. China has already taken steps in order to try and peg its currency, with a clutch and with a sort of group of other currencies rather than just the dollar. So you think that many emerging countries, as far as an impact, a depreciation on their currencies are concerned, is a given, largely?
I think so. The most vulnerable of the emerging market currencies are, of course, those of countries that are commodity exporters, the Russias, the Brazils, and so forth. I mean, in the past 3 years, the Indian rupee hasn't been hit that hard. A little bit, but it's not a huge hit. The renminbi, of course, the Chinese renminbi is the one that's on everybody's sort of radar screen right now, mostly because China's huge. And it's, after years of upward pressure on the renminbi, we're now seeing downward pressure on the renminbi. So the worry, as you're saying, is that a Fed rate hike would put further downward pressure on the renminbi. But I think the Chinese central bank and the government will do what they need to do through sterilized interventions or other things to prevent a big collapse in their currency.
Right. When you talk about this, you of course talk about the possible capital outflow. In fact, our colleague also in Beijing was precisely mentioning this. And we've seen how the Asian financial crisis sort of triggered a larger debate about about capital account convertibility. So in that sense, how do you look at this debate as far as capital account convertibility is concerned? Because the Asian financial crisis, of course, even prompted institutions like the IMF to sort of voice their sort of concern in terms of full capital account convertibility. So do you think in that sense, capital outflow is a given for for emerging markets, and thereby it increases the vulnerability of emerging markets?
Well, there's no doubt about that. And already we've seen quite large capital outflows from emerging markets. Will that accelerate or continue? Certainly it'll continue in 2016 as the Fed hikes rates. Will it accelerate? It's hard to say. But yes, unfortunately, that's sort of part of the picture here, is that capital flows out of emerging markets in these episodes when the Fed raises interest rates and into the U.S., where the yields are higher, if you will, and there's still a safe asset. So again, unfortunately, that's that is a problem. I think again, some countries more vulnerable than others, countries that are struggling. India, on the other hand, is doing fairly well growth-wise, and so I'm less worried, let's say, about India than I am about Brazil or Russia or South Africa.
Right. In fact, very recently, in fact, just a short while ago, there was also this a statement by Ben Bernanke, which came out in the form of an interview, where he said that there is a possibility of the U.S. Fed also in the future somewhere using negative interest rates, the negative rates to basically force banks to utilize their money more, much like what, ECB has done recently, where they sort of brought down their rates to negative 0.3%. Do you think that is a possibility at all?
I think it's a very low probability kind of scenario for the U.S. right now, precisely because we seem to be moving in quite the opposite direction. It's a bigger problem in much of Europe because European banks are still in some difficulty. U.S. banks are much healthier now than they were, say, 5 to 6 years ago, certainly, but they're healthier than their European counterparts and more willing to lend. And so I think that imperative to lower interest rates below zero is greater in Europe than it is in the U.S. So it's always a possibility, but I don't think it's very likely for the U.S.
We'll leave it at that. Nariman, thank you so very much for joining us here on The Big Picture on the CNBC TV 18. Thank you so much for your time.